Hello, ladies and gentlemen. Let's take a walk through the practice problems for Chapter 14. This should be somewhat short and sweet. We only have a few formulas that we need to keep in mind here. This chapter, the first question that we're looking at here is comparing some different measures for divisional performance. So we're going to look at, in this case, return on investment and also the EVA that's talked about in your textbook there. So for our first question, is asking us to calculate the ROI for both the North and South divisions here. And all you simply need to know is that ROI is the result of operating profit being divided by divisional investment. So if we're talking about the North division, we're talking about 6 million divided by 30 million, and that gives us 20% as our ROI. If we do the same for the South, 40 divided by 320, we find 12.5% as our return on investment. The second question here, remembering that we have 20 for North and 12.5 for South. Second question is asking us if these, if the company measures performance using ROI, which division has the best performance? Obviously, it's the North because the ROI is highest there. Requirement B1 asks us to calculate the EVA for both of these instead of the ROI. So if we're looking at EVA, we're talking about how much more is operating profit than the percentage of our cost of capital times the investment. So the cost of capital in this case, I believe, was 8% somewhere. Where did I see that cost of capital number? Here it is, 8%. 8%, we want to take the 8% and multiply it times the investment amount. And what we're really saying is this is how much we should be receiving in income or in profit based upon our required 8%. And I want to know how much more than that we're receiving. So I'm going to take 8% times 30 million, and then I'm going to compare that to the 6 million that I earned. So in the case of the North, this would give us an EVA of $3,600,000. So I'm $3,600,000 above the required amount in this case, the 8%. Okay, so if I do the same for the South, taking the operating profit minus the product of the cost of capital and investment, I should end up with 14,400,000. And in this case, if I am using the EVA as my performance measure, then I had the South with the highest number here. Okay, looking at part C, it says, would your evaluation change if the company's cost of capital was 16% when it's evaluated by the ROI? Excuse me. So looking at this from the ROI's perspective, if you recall when we looked at ROI, we weren't even looking at the cost of capital. So it had no impact on it whatsoever. So this is a no. The EVA, however, if we were changing the cost of capital, then obviously this is going to impact it because we have doubled what the requirement is by changing it from 8 to 16%. That's it for question 1. Let's just check our work, make sure we're good, complete and correct. Moving on to question 2. This one has us evaluating the performance of 2 divisions using BMI. Excuse me, assuming that BMI is using the ROI as the investment tool. So very similar to what we did in the previous problem here. We're just calculating the return on investment by taking the income. Notice they're just calling it income. The last time we called it profit. So just recognize the terminology and how in some cases it's synonymous with some other words there. So you want to make sure you remember that. If we take income divided by investment, we end up with 10% for the East and 13% for the West. And that should be good. Question 3. With this one, we are evaluating the performance of the same company as question 2, but we're using residual income in this case. And to calculate the residual income here, we're going to look at our cost of capital, which in this case is 15%. We're going to multiply that times the investment that we have, this 2,000 for the East and 3,000 for the West. And we're going to compare that to the income that we have here. So it sounds a lot like the EVA. So the East, if we do the math on this one, we find that our income is $200 less. It's going to be $200 less than the investment times the cost of capital. So we're looking at a residual income of 100. And for the West, if we do the same calculations there, we have 390 for our income, and then our investment times cost of capital is 3,000 times the 15%, which gives us 450. So 390 minus 450 gives us a negative 90 there. So our residual income is negative 90. That should be it for this one. Oops. What did I do here? Oh, 450 minus, I got the wrong number. 450 minus 390 is 60, not 90. That should be good. Okay. Which division had the best performance? They're asking us in this case, West, because it has the least negative number. So this is actually a higher number than the 100 here. So West is our, get out of that mode, go back to this mode, and we have West. Question 4. We are just taking a look at return on investment, and we want to calculate it before we make an acquisition and then after we make an acquisition to see how much our return on investment is going to change. This becomes very critical at times and something that the finance department definitely has to calculate in many cases where a company might have outstanding loans with covenants. What do I mean? There are some conditions that the bank says you have to continue to operate under. Otherwise, your loan could be called immediately if they find out that you have you're operating outside the boundaries of some of the conditions or covenants that have been established with some of the conditions that have been established within that loan covenant. So what we want to do here is take the ROI. In this case, the company is currently earning 2.34 million and has divisional assets of 19.5 million. The manager is considering acquiring a new asset that will add to profit. The investment is going to cost 3.375 million and will have a yearly cash flow of $840,000. The asset will be depreciated using straight line over 6 years, no salvage value. Divisional performance is measured using ROI with beginning of the year net book values in the denominator. The company's cost of capital is 9%. Excuse me. So what we want to do is calculate the return on investment before the acquisition, which is simply our current earnings, the 2.34 million, and divide that by the 19.5 million. That will give us a 12% return on investment before we acquire this new asset. Now we have to figure out what's going to change if we purchase this asset. So what's going to change as far as my operating profit is concerned? I want to take the 2.34 million, but I'm going to add, what did we talk about here? An additional cash flow of $840,000 is what they're saying, but that's not income. This is cash flow. When I look at the income, this cash flow here, I have to remember this depreciation aspect of it here. So I want to subtract the depreciation from that cash flow because that's what would represent the profit. What's depreciation? Is going to be the 3.375 million divided by 6 years. So if I do that, if I do the math on that one and subtract it from 840, then I will end up adding $277,500 to my income amount of 2.34 million before I purchase the asset. So in doing the math on that, then I'm going to divide it by 19.5 million plus this additional investment cost, 3.375 million. So again, I'm going to have 2 million, the 2,340,000, and I'm going to add to that $277,500, which is depreciation for 1 year. That's my numerator. My denominator is simply the 19.5 million plus 3,375,000. If I do the math on that, my new ROI is going to be 11.4%. And that one is complete and correct. And our final question here. Harbor Division has total assets net of the accumulated depreciation of $600,000. They lease a machine for $12,000 annually. The expected divisional income for year one is $92,400, including $5,400 in income that's generated by the leased machine after the lease payment. Harbor's cost of capital is 12%, and they can cancel the lease on the machine without penalty at any time, and is considering disposing of it today, which is the beginning of year one. So what we're doing here is calculating the return on investment before we dispose of this, the return on investment after we dispose of it, and then the residual income in the before and after scenarios as well. So the first thing we want to look at here is our return on investment before we dispose of it. We're looking at income of $92,400 divided by the $600,000 in total assets. This gives us 15.4%. After the disposal of this asset, we're looking at $92,400 in divisional income minus the $5,400 that is specifically generated by this leased machine. So if we do the math on that, that's going to change what the income is, and then we're going to still divide that by 600,000 because that is still representative of our total assets there. So we are looking at, in this case, our income, 92,400 minus 5,400 gives us 87,000 in income here, and we're going to divide that by 600,000, and that gives us 14.5%. Those are the two ROIs. Let's look at the residual income before and after the disposal. If we look at residual income again, we're going to take our $92,400 income. This is the before scenario. From that, we're going to subtract 12% times the 600,000. This will tell us how much more than the required return on our investment we're actually expecting to earn. So if I look at the 600,000, multiply that times 12%, our what the company is saying is that we should get at least $72,000 a year in income from these assets based upon our 12% cost of capital. So I'm going to compare the 72,000 to the 92,400, and this lets me know I have $20,400 above what is required if I'm using a 12% cost of capital. After the disposal of this asset, I'm still looking at the 600,000 times 12%, but this time I'm going to subtract that from not just the 92,000, but I also have to remove that $5,400 in extra income there. So if I do the math on that, I end up with $15,000 as my residual income. Again, that's going to be $92,400 minus the income that's lost, the $5,400, I'm going to take that difference there and subtract from it the $72,000 that's required based on the 12% of the $600,000 here. Answer is complete and correct, and that is actually the end of the practice set for chapter 5. Should be a pretty light chapter for you.